Hello, I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and finance. This week, an anniversary to forget. It's 5 years since the financial crisis gripped the world. You'd think things might have changed, but foreclosures are still rising and the too big to fail banks just seem to be getting bigger. Also this week, what happens when oil is spilt, the Nigerian farmers who lost it all, and the oil giant trying to make things right. And the plane that reaches parts of the world other planes give up on. We look at what makes the curiously named Otter such a success. So, doesn't time fly when your economy's in a hole, there are no jobs and homes are still being repossessed? I wish I was joking there, but as you'll see on this week's show, that is the reality in the United States, 5 years after the start of the global financial crisis. We pinpoint that anniversary as September 15, 2008, the day investment bank Lehman Brothers was simply left to collapse. The events that followed rocked every corner of the US economy and the world to varying degrees. And even though the US government spent trillions stabilizing its banking system, propping up the automakers and stimulating the economy, all efforts appear to have led to the worst economic crisis since the Depression more than 70 years ago. We call this program Counting the Cost, so here is the cost. $22 trillion. That's what this financial crisis cost the US economy, according to the government's Accountability Office. Blame for the crisis has been spread pretty evenly and maybe even unfairly. The consensus said that Wall Street was the biggest culprit, but rather than shrinking the problem, the so-called too big to fail banks actually got bigger. Bloomberg research suggests the 6 biggest banks are now 28% larger than in 2007. For example, JP Chase, which if you remember rescued both Bear Stearns and Washington Mutual, it has $2.4 trillion in assets now, up from $1.16 trillion in 2007. But as we always try to remember and remind, this crisis ended up hitting people, not just institutions. At the height of the crisis, unemployment soared and then remained above 8% for more than 3 years. Even today, it's still stubbornly above 7%, despite all sorts of attempts to stimulate jobs growth. And those attempts need to bear fruit at some point. To get back to those pre-crisis levels, the US economy needs another 2.2 million jobs, and that's ignoring the fact that most jobs created are in the low-pay sector. And don't forget where it all started, the subprime loans to homeowners that were repackaged by Wall Street. People were losing their homes left, right and centre when this crisis began. And all in all, 4.5 million homes have been foreclosed upon since September 2008. Now, given that's where this crisis began, we want to look at how foreclosures have been dealt with. Now, the US government has gone out of its way to keep people in their homes, leaning on lenders to renegotiate their terms. But there are a large group of people who fall outside the government's guarantee scheme, and it's led one West Coast city to take some unusual steps. Patricia Sabga has our case study from Richmond, California.
When auto repair shop owner Jose Vasquez bought his house 8 years ago for nearly $700,000, he thought he could afford to stay here forever.
The main question was how much I had to pay for the house for 30 years. The answer was $2,000.
His payments started out that way, only to balloon to over $3,000 per month. Then the housing market crashed, squeezing his business and wiping more than $250,000 off the value of his home. The financial stress affected his health.
I had to go to the hospital, okay, to get help. But I'm sorry.
He's tried to get the principal on his mortgage reduced to reflect what his house is worth now. But he can't, because he and millions of other Americans have mortgages that are locked in so-called private label securities, loans too risky for government guarantees that were bundled together and sold off in slices to lots of big investors. Getting a majority of those investors to agree to reduce the principal on a single mortgage is next to impossible.
Many of these loans were subprime loans that had were targeted at people of color, and we have a large people of color community in Richmond.
So Richmond Mayor Gail McLaughlin is pursuing a radical plan to help homeowners like Vasquez. one that's ignited a legal battle with some of the nation's biggest banks and fund managers, pitting the rights of a struggling working-class community against the rights of investors.
We are stepping in to make a fix that both the federal government and the bank and the mortgage industry and the banks have not been able to do, or they've either been unwilling or unable.
The city offered to buy more than 600 private label mortgages at prices that reflect current home values, so homeowners can refinance with smaller loans, giving them equity in their houses and more money to spend in the community. The city called on the banks to sell the mortgages voluntarily. If they don't, Richmond has vowed to seize them through eminent domain, an unprecedented fix for a city where more than 40% of homeowners with mortgages owe more on their houses than they're currently worth. Keep people in their homes, reduce principal, free up more money to pump into the local economy? What's not to like about Richmond's plan? Well, according to the securities and banking industries, plenty. Wells Fargo and Deutsche Bank were the first to take the city and its advisors to court, arguing that the plan rests on buying mortgages at prices that are, quote, substantially less than the loan's actual value. Both banks declined our request for an interview, but their concerns are echoed by more than a dozen financial industry trade groups.
The missing voice in this debate does seem to be the investor.
Brian Reed is chief economist for the Investment Company Institute.
We have nearly 55 million American families who are working and saving for retirement. We have another 24 million American families who have at one or more retirees. They are all invested in mutual funds and pension funds and exchange-traded funds that own some of these securities that we're talking about.
Stephen Gluckstern is executive chairman of Mortgage Resolution Partners, the firm advising Richmond, which will take a flat fee for every restructured mortgage. He says investors won't lose out.
To the investors, I'd say it's a fair value offer. You're going to receive cash in lieu of a piece of paper. By the way, primarily likely a toxic piece of paper, and you can get cash today. And so you will be better off having a liquid return of your capital so you can redeploy it in other things.
The lawsuit also claims the plan could restrict mortgage financing to the city and potentially harm, quote, the entire U.S. mortgage industry if other cities follow Richmond's lead.
This is going to damage this market quite considerably because investors will not want to invest in these mortgages and banks will not be able to make them then.
With the battle lines drawn, both sides are digging in.
This is a difficult problem. We understand that. We just recognize that this is not the solution.
I've asked them what is their solution, and they have none.
And until one side claims victory, homeowners like Jose Vasquez try to hang on.
I love so much my house. I don't want to leave from here.
So that shows you there's some of the human struggle. But you know, there is malaise on the corporate side too. More than 400 banks have gone to the wall since the crisis started in late 2008, which leads us to ask just what kind of shape the industry is in right now. Ali Velshi, the host of Real Money on Al Jazeera America, put that question to the former chairperson of the Federal Deposit Insurance Corporation. That is the body which guarantees deposits and supervises American financial institutions.
The system is safer now than it was prior to the crisis. Though, as you point out, that's not setting a really high standard, but we do have more capital in the banks, a little bit more stable funding. So there has been some progress, but it's not nearly enough to give us the kind of resilient system we need to be able to withstand another shock, downturn, without, broader systemic problems occurring with the economy.
You know, one of our, that person who responded to me on Twitter said, I'm keeping my money in the credit unions, not in the banks. We should remind people, no American who had money deposited in a bank has lost money.
That's right. So I think the safest place continues to be an FDIC-backed bank deposit, or there's a similar deposit insurance program for credit unions. It's a very strong track record. Nobody's ever lost a penny of insured deposits. So yes, if you want a complete safety, I think that is still your best place to go. But it's kind of a sad commentary. People still have to be fearful. And it's not just people. I think it's businesses, too. There's still a lot of uncertainty about the resilience of the system, the future of a financial system, and people don't commit capital. They don't take out loans. They don't take risks because they're just not sure what's going to happen next.
So we still have issues with risk and capital on the banking side, but the rest of the economy is working better. You can get loans. We've seen home sales surging because people can get mortgages. We've seen car sales surging because people can get credit and they're feeling better and they're better employed. Other than the internal workings of banks, which still need some fixing, is the system working properly? Is the system of banking and exchange working properly?
Right. Well, again, it's working better. Is it working as it should? No, I don't think so. I think we made a mistake in 2009 without doing some fundamental restructuring and downsizing with some of these very large failing financial institutions. So I think we still have somewhat of a bloated sector, still, you know, a lot of speculation, I think, in securities and derivatives trading, not enough traditional lending. We're seeing a bit of an uptick on that, but again, it's the smaller banks that are doing more of the lending, not so much the larger financial institutions. So it's working better. There's less leverage. There's still too much leverage, but there's less of it than there was in the lead up to the 2008 crisis. But some of the regulatory policies as well skew large bank activity into securities and derivatives trading operations instead of traditional lending, which is one of the things we've been trying to get fixed with stronger, improved capital
It's
standards.
part of the reason why people like that woman who tweeted me talked about credit unions, because they associate credit unions with traditional banking and big banks with all sorts of things that we don't understand. Let's talk a minute about regulators. That is one area that we have such disagreement on in this country. There's a group of people who think regulation is the problem in this country. In fact, we just saw this World Economic Forum report out yesterday where American businesses say government and its regulations stand in the way of prosperity. There are others who think we are not regulated properly or enough. You were a very, very effective regulator. Part of that was you, and part of that was that you worked in a system where you could go in when a bank was failing and do something about it. What do you think needs to be fixed in terms of regulation?
So look, I think not all regulation is good regulation. We can, you know, we had some bad regulations that contributed to this crisis. We had a regulation that was promulgated in the middle 1980s that told mutual funds they're called money market funds, could act like banks and not have to be banks, not have to be regulated as banks. And guess what? They ran like banks during the 2008 crisis. We had bad regulations on capital. We had regulations that basically told large banks they could set their own capital requirements, so we need to get rid of those. So, you know, sometimes the regulatory reform you need is getting rid of the old bad regulations in favor of newer, simpler, stronger, more effective regulations. And I think that's really where the regulators need to focus. So much of the regulatory activity, it's almost busy work. You know, we've got really complicated rules, lots of reporting and paperwork, and then, well, what do they really accomplish? You know, it's incremental. It's at the margin.
That was Al Jazeera America's Ali Velshi speaking to the former chairperson of the Federal Deposit Insurance Corporation. Just a quick footnote to all of this, and it really takes us back to the Lehman moment of September 2008. At that time, Lehman was the world's fourth largest investment bank. The reason its collapse was so significant was that it had debts of $613 billion, just slightly smaller than the size of the entire Swiss economy. But did you know Lehman actually came out of bankruptcy last year? The estate is worth $65 billion and creditors stand to get back $43 billion, or about a fifth of every dollar they lost. As for those managing the company right now, well, they're a team of lawyers and accountants who've earned fees of more than $3 billion. Still ahead this week on Counting the Cost, flying otters, a business success story worth telling. We look at one of Canada's most loved planes back in production. So as we've seen, the United States still is, the undisputed home of capitalism. But think about another place, Switzerland, which has eked out its own claim to unbridled financial prowess as the home of the big financial and commodity trading houses. But you see, the easy, lightly regulated path to Zurich is starting to look a little bumpier. The secret of bank sector has been pried open. Swiss politicians are trying to break up the banks. Executive pay is in the spotlight too. And there's a darker side as well, with two unrelated executive suicides, leading many to ask, what's going wrong? Well, for a bit of insight into this, we bring in a regular contributor to the show, Bernhard Bauhofer, who is an expert in reputation management at Sparring Partners in Zurich. Bernhard, these suicides, tell us what the reaction to them has been like in Switzerland, because there is something very unsettling about what's prompted them.
Well, the two suicides were just really seen as a warning signal about what is going on in the business rooms and the boardrooms in the Swiss companies, because both CEOs, both executives were very successful, and apparently there were no sign that they were having depression or a burnout. And all of a sudden, they were taking their lives. And now the Swiss public and media are questioning corporate culture of Swiss companies, if it's too tough, if the pressure is too high. And my personal opinion is that there's a governance problem. Apparently, the board of directors, the board of the supervisory board, the president is taking influence on the operational business and causing problems. And apparently people felt so desperate that they had to take their lives. And Swiss public is very concerned about that fact.
Okay, so the public's concerned, the media's concerned, you've given us your view as well. How are the corporates actually responding, though?
Well, Zurich, the insurance company, is saying that they're taking really serious action. They're looking at the corporate culture. They're trying to improve the business climate. And the president, Mr. Ackermann, stepped down and was replaced today by a successor. So there are consequences, but we know from many other companies that the change of corporate culture is very delicate, particularly in this global business environment where the shareholder value is so tremendous. And in the case of Zurich has to improve its profitability. So my personal opinion is this will take time to improve, and the circumstances are very, very rigid and very tight. And I'm not very optimistic about about a positive outcome of the improvement of corporate culture.
What's happened, though, Bernard? Why is it so out of control? Because, you know, we've talked about the United States being the center of capitalism, but this is a different type of capitalism which seems to go largely unchecked, and I want to know what's led to that.
Well, there are strong comparisons between Switzerland and the US, both 100% capitalistic countries. We have in Switzerland the Protestant theology, which says you have to work hard. But contrary to the United States, where you can accept failure, failure is not a thing here in Switzerland. You have to show your perfect face. You have to function. You cannot show any weakness. I think that's one of the key differences between the United States and Switzerland, which eventually led to these suicides, which is very sad because there were people that were having everything, lots of money, having their family, very successful, but apparently they couldn't cope with this pressure and couldn't commit failure and weakness.
On another note, Bernard, the issue of remuneration, or if I use a more colloquial term, fat cat pay. It seems there is now a bit of backlash against how much the executives are getting paid. Again, does that perhaps seem odd to you, given that that's kind of what Switzerland's all about? People are there in business to earn as much cash as they can.
Well, I think we're seeing now a major change in the public perception and the public sentiment about capitalism and in general here in Switzerland. If you talk about the difference between rich and poor, we think the biggest gap between rich and poor in Switzerland, on a very high level, of course. But CEOs were gaining 20, 30 times the money of a normal worker, which caused really uneasiness within the population. And the pressure on the top executives were increasing on the supervisory boards to reduce these payments to a reasonable level. And the pay cat, fat cat, initiative was accepted by the public. So that shows that capitalism is now really, at least the capitalism we are seeing now in this globalized world is now really questioned from Swiss public.
That's Bernard Bauhofer joining us from Zurich on the current business climate there in Switzerland. Thank you, Bernard. Now, the oil giant Royal Dutch Shell has begun talks with the Nigerian community on compensation and cleanup. Now, it is 5 years since one of its pipelines burst and spilled oil into fishing ponds, but Shell has admitted responsibility even though it disputes the extent of the damage. Yvonne Ndege takes up the story from Bodo in Rivers State, Nigeria.
Christian Kapandai shows us the damage caused to his fish ponds. They were destroyed when a poorly maintained pipeline owned by the oil company Shell burst twice in 2008. thousands of barrels of oil gushed into the ponds.
When I came, I discovered that all the 4 fish ponds were covered with crude oil. I began to see the fish trying to escape for life, but the whole place was dark. And in fact, when I saw the money that had been put in and the labor, in fact, I nearly fainted. Our livelihood is totally destroyed. For me to survive now, it is just by the grace. I, who used to give to others, is now become a beggar. I live on a charity.
Shell admits it caused the damage. The company has agreed to pay compensation and clean up the area, but it disputes how serious the damage is. That disagreement could affect how much compensation it ultimately pays.
Shell says around 4,000 barrels of oil were spilled here, but lawyers for the victims say it was much higher, around 500,000 barrels.
Getting Shell to agree to pay any compensation is a legal victory for the people of Bodo. The victims of the oil spill had to take Shell to court in the UK to get the company to accept responsibility. The Nigerian government is now enacting a law that would help victims get justice.
We haven't had a framework clearly stating what is the responsibility of a responsible party where he has spilled. In fact, I can tell you that it has been very economical to spill as many barrels of oil that you like in Nigeria and go scot-free.
Christian hopes the new law will hold oil companies accountable when oil spills occur, but he's still very concerned about Shell's activities in the region.
I believe that Shell want to wipe away people of this area. That is why, so that they can have their way. The God of the land and the Almighty God who placed us here will never make them to escape all that they have done.
Shell denies such allegations and says its compensation settlement will be fair and the cleanup of the area will be prompt.
Finally this week, otters. Flying otters. Twin flying otters, actually. Not to confuse, but the Twin Otter is actually one of Canada's most famous planes. It's also a business success story because now it's back in production. Daniel Lack has this report on an icon still going strong.
Think of it not as a sports car, but as a pickup truck. One that flies and can take off and land almost anywhere with a few hundred meters of space. It's hard to imagine a more versatile aircraft than Canada's Twin Otter. Just ask a pilot.
Everybody loves this airplane. It's one of these cult airplanes where you'll find a lot of pilots that have started to fly the Twin Otter, and they just want to fly a Twin Otter and fly nothing else.
But being rugged and popular didn't stop the Twin Otter from going out of production in 1988. It simply didn't fit the business plan at Boeing, which owned the company at the time. Enter Viking Air, an aircraft parts maker from Western Canada that bought the original designs and started making Twin Otters again in 2008. They've sold 80 planes so far and are producing a new one every 10 days.
I've been to about almost every country in the world, and we're placing aircraft in North Africa, we're placing aircraft in Asia today as we speak. We have aircraft going into the Middle East. The one behind us is going into the UAE. So the aircraft is covering the entire spectrum. And the other beauty of the aircraft is, remember, one aircraft does all those jobs.
Conceived as a way to move Canadians through their often harsh landscape, the Twin Otter is now the utility aircraft of choice from the Maldives to Peru, from the Argentine Antarctic Naval Base to the Himalayas of Nepal. But at its heart, say the new manufacturers, it's really all about Canada.
It's a very Canadian airplane. You know, we would never have been able to sell to some of the customers that we were talking to early on without that kind of recognition of a great Canadian airplane.
With more than 800 aircraft produced since the 1960s, this is a plane that'll be carrying people and goods around the world for decades to come.
The Twin Otter adds new meaning to the phrase, ahead of its time. It first flew half a century ago, and now the world is rediscovering this remarkable aircraft that seems able to take off, fly, and land in almost any conditions. Daniel Lack, Al Jazeera, Victoria.
And that is our show for this week, but there's more for you online at aljazeera.com/business. The latest business headlines are there, plus all of our previous episodes for you to catch up on. You can also get in touch. You can tweet me at Kamal AJE, our business editor at Abid Oliver Ali, or drop us an email at countingthecost@aljazeera.net is the address. But that's it for this edition of Counting the Cost. I'm Kamal Santa Maria from the whole team. Thanks for joining us. The news on Al Jazeera is next.